In this video, we'll discuss the warning of a billionaire investor and founder of the world's largest hedge fund about how we are coming close to the end of the economic cycle. Billionaire investor Ray Dalio, founder of Bridgewater Associates, warns investors that it has happened before and will happen again. Due to the same thing continuously happening in markets, according to Dalio, preparation is called for. There are 6 stages to the cycle that will be discussed in this video. Dalio explains that there's the early part of the cycle where debt is being used to create productivity incomes, and then it can be serviced as well. Everything is fantastic as asset prices rise. The cycle bubble phase has arrived, and you're in a position where everyone is extrapolating the past during that bubble time. Because assets grow, people believe assets will continue to rise, according to Dalio, and you borrow money and leverage. And when you're at that stage, when we're doing the math, you could realize that you won't be able to maintain that pace of debt increase. You come into the third phase of the cycle, which is the top. That's typically the part of the cycle when central banks start to put on the brakes, tighten monetary policy, and the like. Then it's time for the down leg. When interest rates reach 0%, you enter the depression stage of the cycle because monetary policy does not act normally at that point. Then there's quantitative easing, which kicks off the expansion, which is then called on, and the cycle starts all over again. Given the situation, Dalio thinks the period that we're in is very similar to the period that we're in the 1930s. There are only 2 times in the history of this century where we had a debt crisis in which interest rates hit 0. And in both of those times, the central bank had to print money and go to a different type of monetary policy and to buy financial assets. It's also caused populism. More populism because that process creates a gap between the rich and the poor. Dalio said that we have a political situation in terms of having more of a conflict between the rich and the poor. Right now, the net worth of the top 0.1% of the population equals that of the bottom 90% combined. That sounds a lot like the 1930s, when we had all of that stimulus and so on. Asset prices are up, interest rates are low, and we're beginning a tightening of monetary policy, very much like in 1937. Dalio explains, if we're in the latter part of the cycle, the part of the cycle in which monetary policy is tightening, and there's not much capacity to squeeze out the economy, if they rise faster than is discounted in the curve, it can hurt asset prices. He said asset prices are fairly fully priced at this level of interest rates. Dalio added that we're going to have a downturn because that's why we have recessions. Dalio said he's worried about how severe the downturn will be, but believes that it's not going to happen right now. During these eras, there is a competition between an established power and a developing force. Back then, the United States and England had won World War I and we were at peace, but Germany and Japan were on their way up. Ray Dalio believes that we are in a scenario where there is a growing China and an established economic power in the United States. There might be rivalry and even animosity. Although the parallels are striking, this does not imply that the same results must occur. Rather, we must be aware of this fact. We have to be cautious on the downturn, the wealth gap, and the consequences geopolitically. Now, what do you think normal investors should do? According to Dalio, there are 2 important aspects to investing. What is your strategic asset allocation is a question. Then there's the bouncing around. In alpha, there are tactical bets. And Dalio believes that the normal person should avoid making tactical wagers in order to generate alpha since he will make mistakes. Alpha is superior to the average. Many would think that now is the best moment to purchase and now is the best time to sell. That is not something you should do. It has a distinct history. He says that while Peter Lynch led the Magellan Fund, which was the best performing stock fund in the whole stock market at that time, the typical investor lost money. So how is it even possible? This is because people bought when it was very hot and the advertisements were there And when it had a period of bad performance, people got scared and so they got out. Market timing is a very difficult thing for investors who put hundreds of millions of dollars each year. Investors should understand how to achieve balance and diversification in operating. If you're going to play the cycle, then realize that the best time to buy is when there's blood in the streets is the same. Sell when everything is great. Everybody's extrapolating the past, and you're near the end of the cycle. As the employment rate gets low, asset prices are high, debts are being built up, and everyone's extrapolating the past. That is the time to sell. First of all, according to Dalio, you need to look at how much slack is left in the cycle. Look at the unemployment rate. Where's the capacity? What is the central bank doing? Is it tightening monetary policy? Or is it an easy monetary policy? Second, you look at how much debt has been used to finance those purchases. Third, you look at the amount of sentiment, the euphoria. And fourth, compare the yield on stocks and the yield on bonds and the pricing at credit spreads. Ray Dalio believes the situation is a picture of the discounted future, which is an extrapolation of what happened in the past to something that's unlikely to happen going forward. This will be difficult times, not immediately, but according to Dalio, maybe in a few years. Now, what do you think about Ray's warning? Comment down below. If you enjoyed this video, please hit the like button and subscribe. This is your Top Tech and Trades channel. Thanks for watching, and I'll see you in the next video.